All right, let's go ahead and get into it. Um, I am Glenn Sedgefield, the VP of Marketing for DMI. And if you're not familiar with DMI, we're an IMO based in Boston, Massachusetts, with 35 years of experience helping financial professionals improve business performance. And by popular demand, we've been asked to put together a webinar series on LTC. So that's just what we've done. And with the help of Mike Johnson, AIN Director of Member Services, and our very own Josh Rhem, Life Sales VP. Mike has served as an internal wholesaler, helping financial advisors enhance and protect clients' wealth with life insurance and asset-based long-term care. And then Joshua Rhem has 15 years of experience in insurance and investment services, with experience as a registered investment advisor to financial institutions, an insurance producer, and wholesaler. Really appreciate you guys being here on this webinar. And on this webinar, we're going to aim to break down the differences between life insurance-based LTC and asset-based LTC. On the next one, because there is a part two coming up in a couple weeks, we're going to discuss an opportunity to help your clients turn a taxable, non-qualified annuity into larger tax-free dollars for LTC and much more on that one. So you'll be getting invites to those as well, or to that webinar as well. Please feel free, as always, to use the Q&A function to ensure that you're getting the most out of our experts today. So we'll mostly answer those questions at the end of the webinar. But let's get into it. Josh, I'll hand it off to you. What do you think about the webinar today?
It's a good webinar, a good topic. Thank you, everybody, for coming. And it's a good topic because when it comes to something like planning for retirement, nothing ever goes exactly as planned. So you got to account for some what-if scenarios. And long-term care is a what-if scenario that really cannot be ignored. And that's because if a long-term care need is realized, and it's realized at the rate of $120,000 per year in many states or more to pay for that long-term care, well, that's going to be well outside the scope of anything that could be considered a safe rate of withdrawal from a portfolio. So a long-term care expense is going to deplete a client's assets much quicker than they could possibly be replenished. So it'll change your client's retirement profile. And if you are an assets under management based practice, that's going to have a big impact on your business. So really, it's not whether we should talk about long-term care, it's how do we address it? What type of approaches should we take? And that's why at DMI, we're fortunate to be able to arm ourselves and arm you as the agents with experts like Mike and Andrew. And Mike, I understand you came prepared today to help us sift through some of these options, when to use them, and why. So we'll kick it over to you, Mike.
Excellent. Yeah, thank you so much, Josh and Glenn. I really appreciate the intro. And really, I think the two of you said it best. This is such an important topic, and I'm so honored to be here on the presentation with you all. So again, thanks once again for the opportunity to do so. And so again, my name is Mike Johnson. I'm a specialist in asset-based long-term care. A little bit of backstory on me. I've been in the insurance industry for over 10 years now, with BGA and wholesaling experience in both life insurance and long-term care. So like I say, very excited to be a part of the presentation today. So we'll go ahead and get things started, and I'll share my screen.
Thank you, Mike.
All right, perfect. Now, so again, the theme of our webinar today is that debate of which option is best, right? The asset-based long-term care solution or life insurance contract with a long-term care or chronic illness rider. It's really no surprise that this debate is getting a lot more attention. That demand for extended care planning has never been greater. That demand will only continue to grow. It's really important to look at what's causing this demand. The numbers that I'll share with you now will certainly be eye-opening. When we think about our aging population, the last of the baby boomers will turn age 60 in 2024. In 2030, All boomers will be age 65 or older. That will make up to 20% of the US population. That's up significantly, up from 17% in 2022. In 2050, right, the number of Americans that are age 65 or older, that's projected to reach up to 82 million. That's a significant leap up from 2022 as well. That represents 23% of the US population. My goodness, by 2055, the ranks of those age 85 and up, that'll swell up to almost 18 million. So with all of that growth, it's certain to lead to a significant increase in the number of people who will need long-term care planning. And also consider this, someone that's turning 65 today, they have nearly a 70% chance of needing some type of long-term care services and support during their life. And with the increasing prevalence of a lot of cognitive challenges like Alzheimer's and dementia cases, in many cases, that can require lengthy long-term care coverage that could last for 10 years or more in some cases. Also, when we think about this, the unfortunate reality is Medicare will not cover long-term care expenses. And although Medicaid is sometimes viewed as kind of that go-to safety net in the US healthcare system, there's a huge strain on the Medicare program. And as a result, Medicaid is insufficient. And not only that, for covering those long-term care needs, but it's also underfunded by the US government. In our political and economic climate, those two shortfalls are likely to get worse before they get better. So I'm bringing up these statistics to really emphasize that there's never been a greater need to plan for these extended care and long-term care needs, now more than ever. Your clients they have a variety of options now to secure that coverage that they need. So let's spend some time going over the differences of which options will suit your client's needs best. Now, when we think about the different product types, you'll see that there's going to be the three products that you're likely familiar with, right? There's traditional long-term care. There's asset-based long-term care. It's also referred to as linked benefits or sometimes referred to as hybrid products. For our purposes, we'll call it asset-based long-term care, or ABLTC for short. And then, of course, life insurance with a chronic illness or long-term care rider. Now, with traditional long-term care, you'll see that naturally the primary focus is on long-term care funding, right? So you get the most bang for your buck with your premium dollars, and that has the lowest cost of entry. And the younger the policyholder is when they buy, the lower the premiums will be. But premiums will increase over time due to factors such as inflation adjustments and insurer rate hikes. Now, as a result, traditional long-term care insurance, that the sales continue to lag. Most buyers are really turned off by the use it or lose it nature of traditional long-term care insurance, and they take offense to those rate increases. And also, when we think about it, long-term care insurance policies that were sold 20 years ago or more, carriers have instituted in-force rate increases on their books of business. So it's really no surprise that traditional long-term care has fallen out of favor, making ABLTC that preferred option in most cases if coverage is the primary focus of the insurance. Now, the other side of the spectrum is going to be life insurance with the long-term care rider. With life insurance, as we know, the purpose is to leverage those premium dollars, leverage that death benefit as best as possible so we can protect our personal and business interests, the living benefits with the life insurance contract. That's a major selling point, right? So where in this case, the insured doesn't have to die to realize the benefits of the life insurance, and this can be a big appeal of that long-term care rider. So when the insured has that triggering event, that death benefit can be accessed early to cover long-term care expenses. in most cases where a long-term care rider is available, but premiums will typically stay level and guaranteed. But it's also important to note that depending on the way that the policy is designed, careful attention has to be paid to the way that that's structured. And so withdrawals and loans, that can impact guarantees. There could be that potential for those guarantees to be affected. So also note that with life insurance, there is no inflation protection with a long-term care rider, but with an option to death benefit, as I'm sure we're all aware, that death benefit will grow over time, and that can somewhat mimic an inflation protection component that you see with traditional long-term care and ABLTC contracts. Now, when we consider the middle of the slide here, ABLTC insurance. So if the purpose of this insurance is to leverage those long-term care dollars as best as possible, ABLTC is a natural fit here. See, we offer guaranteed premiums. It offers a guaranteed death benefit. And that can be passed on to the beneficiary if the care isn't needed. There's guaranteed cash value growth that takes place to offer some liquidity in the contract. And the ABLTC option offers various inflation protection riders as well. And in some cases, the way that those riders can be enacted, it can extend that pool of funds for an unlimited duration if needed. So this is a major advantage with ABLTC. And like we mentioned a little bit earlier, with cognitive issues like Alzheimer's, dementia, that long-term care need could extend for a decade or sometimes even longer. So that's important to note. So when we take a look at this slide, we'll see these different options, but the bottom line is this: it's a good thing that your clients have all these options to choose from. But again, which option is best suited for your client? Well, let's take a closer look at that. But before moving on to that next slide, are there any questions?
Maureen, did you have a question? Is there a question?
We do have somebody raising their hand, Maureen. I don't know,
Yes, let me see if I can call on Robert. I don't know how I got my raised hand. That's fun. I think it might have been taken down, Glenn.
No worries.
Cool. Well, if it comes back towards the end, just let us know. We can address it.
Absolutely. Thank you.
But yeah, great summary of the products that are available. And it sounds like, in summary, we have all these products that are available, but to know initially which direction to go in has a lot to do with what emphasis is being placed on long-term care. So if their client is really focused on getting the most long-term care benefits possible, then that would lend itself to a particular solution. Whereas if they want life insurance and long-term care insurance would be nice as a secondary option, that would lend itself to another solution. So the emphasis is what might help point us in the right direction, at least initially. Is that right, Mike?
Yeah, absolutely. I couldn't have said it better, Josh. It's all about where we're looking to leverage those dollars as most effectively as possible. There's not necessarily a right or wrong answer here, but that's where we come in as that trusted advisor, and we can help pinpoint the client in the right direction, help isolate which option is going to be the best solution for them moving forward. So yeah, that's a great summary, Josh.
Nice. Thanks, Mike. Sure.
Absolutely. Well, excellent. So shifting gears a little bit, I think that's a great segue into this next slide. So when we consider the different funding strategies with asset-based long-term care, a single pay option is not the only option available. And I say that because in the past, with asset-based long-term care, the options were more limited. There was typically a single pay design, or in some cases, there was a 10-pay design that was available. Now, although a single pay option could potentially be a great fit for some, that could be cost prohibitive. Now, as this slide shows, the majority of policies that are sold today, this is over 56% of the policies are sold in a continuous premium design. Now, this is great news for your clients, as carriers are offering a great deal of flexibility with these pay designs. And it makes that style of coverage even more affordable, because studies show time and time again that the cost is a big concern in planning for long-term care, and can be a big barrier to entry to look at this type of product. Now, when we take a look at this slide that we have featured here, we're featuring a 10-pay scenario. Okay. So this is a 10-pay scenario where it's a male, age 60, funding the annual premium $10,000 a year for a 10-year stretch. Now, when we compare and contrast the different product options, you'll see here that the life insurance rider with long-term care, that's going to offer the most significant death benefit leverage right off the bat, 3 times death benefits leverage. Now, in this scenario, we're showing universal life contracts that are protection-based, guaranteed at or beyond life expectancy. Now, these options perform well, not just with guaranteed durations, but you also see that they build cash value along the way. And that can offer a lot more flexibility and opportunity that you don't typically see in most traditional protection-based universal life contracts. You'll also see that long-term care rider, that can be used to tap into the death benefit for long-term care expenses. And that would deplete the death benefit over the span of 50 months if the insured were to remain on claim. So if your clients are looking to leverage that death benefit and included living benefits rider like long-term care, that could potentially be a great fit. But again, remember that main purpose of the coverage is to leverage that long-term care funding. You're not going to find a better option than ABLTC. So keep in mind that with ABLTC, it's designed to maximize that pool of long-term care funds as much as possible. Now, in this scenario, we've highlighted age 80 in the summary table, and that shows a significantly higher pool of LTC funds, as well as a much higher death benefit, a much higher monthly LTC benefit that the client can tap into when they need it most. Now, ABLTC products are built primarily on a life insurance chassis, which offers that guaranteed death benefit if care is not needed. There is a modest amount of cash value growth. The policy can include an inflation rider. And in this scenario, we've shown a 3% inflation rider, which grows that pool of funds over the course of time. And that gives your clients the peace of mind that benefit will keep up with inflation.
And on the topic of peace of mind, Mike, there's always a good amount of liquidity that our advisors, agents hold, and sometimes they might have even more liquidity than what they need. But just having access to their money is always something that makes them feel safe and secure. So with these asset-based long-term care products, there are good liquidity features built into them that we could kind of present it as though we're just repositioning an asset instead of giving up an asset. Is that the case?
Yeah, absolutely. I think that's a really wise observation there, Josh. So again, just remember, we have so much flexibility and opportunity with, and again, one of the biggest detractors from traditional long-term care was just that aspect of use it or lose it. There's no liquidity. There's really no cost recovery. And if that option is available, it can be, in many cases, cost prohibitive. So I agree with you wholeheartedly, Josh. That's the big win with the ABLTC across the board, without question.
Nice.
Very good.
Hi, Maureen.
I do have a quick question. While we're on the subject of ABLTC, what are the different annual premiums for these options based on standard rating?
Sure. So the different premium options, this is the great option here. So in this scenario, we've showed a 10-pay. Now, many carriers are offering a recurring continuing premium. In some cases, it can be a 5-pay, a 7-pay, a 10-pay, a 20-pay, or it can even go up to a full pay design where premiums can stretch out to age 100. So the great news there is that gives your clients a lot of flexibility and optionality, and it can make the coverage even more affordable the longer they can stage that premium in. it's a perfect segue into this next slide that we have to share with you. But I think it's important to note now more than ever, there's so many different ways to fund the policy with various recurring premium designs that can be an ideal fit across the board for your clients. Great question. All right. Excellent. So in addition to this, I always like to highlight this, that in this table with ABLTC, you can also see that there is an annuity chassis that your client can benefit from as well. Now, in this scenario, we're showing a single premium deferred annuity that's used to fund that life policy that's based on the life policy, the ABLTC policy based on a whole life chassis that maintains that guaranteed death benefit, guaranteed cash value growth, ultimately offering a component of cost recovery that, again, you don't typically see in traditional LTC. So when we think of a source of funding, some of your clients, that, let's face it, they may have some assets that are sitting idle, like a non-qualified annuity. Likely that's earmarked for future long-term care needs. Josh alluded to this a little bit at the beginning. With legislation that's been passed recently, those tax-deferred assets, like we described, that can be used to fund long-term care. And when those funds are used for qualifying LTC expenses, those funds can be used to leverage an even larger tax-free pool of long-term care benefits. So the bottom line here is this is a great opportunity. Schedule an annuity review with your clients. Really help you establish yourself as that trusted advisor. Help your clients, help them make the most of those assets and create better tax efficiency overall. So on this slide, when we think about this and we say, why does this 10-pay design matter? Well, the bottom line is this: is your clients have more flexibility, as that single pay option is not the only option, and making that access to this type of coverage is even that much more affordable. And as I mentioned before, great segue into this next slide, right? So we also have a scenario where we're showing a life pay design. Now, this is a little bit different than the last summary table. We're showing a male age 50, funding $5,000 a year, and that's paid all the way out to age 100. So again, as we mentioned, with cost being one of the biggest hurdles for most clients that are considering this type of coverage, that life pay can offer a lot more affordability to those that have maybe some other financial obligations that make that shorter pay design a little bit more difficult to achieve. And like we saw before, we're seeing strong death benefit leverage with the universal life products. We're guaranteeing that death benefit at or beyond life expectancy, with that liquidity component with cash value growth, and of course the ability to tap into that death benefit for a qualifying event when the client goes on claim. But it's also really important to note here, with ABLTC, this design is compelling, right? As that leverage is significantly higher with the LTC pool and in the monthly benefit. So in this presentation, the common thread is what's the most important aspect of the coverage, and where are we looking for the most leverage? Is it death benefit? Is it long-term care? So I think this is a great way to illustrate that there are numerous options for your clients to take advantage of, and this optionality is a good thing. Self-funding, right? That's an important option to note as well. So self-funding, that is an option, but it might not be the most efficient option, especially from a taxation perspective. So if we're depleting assets from a portfolio to self-fund care, well, that likely impacts the client's cash flow in retirement. So bottom line is we can explore many different options that not only sufficiently fund their care, but also do it in a tax-efficient manner as well. And also keep in mind that 1035 exchanges are a great funding source as well. So typically a 1035 exchange, you're not going to see any kind of negative tax consequence. And this is applicable for ABLTC policies. Those 1035s can be utilized. Great way to capitalize on this opportunity, really create that win-win scenario, helping your clients lock in that coverage at a most affordable rate in the most tax efficient manner possible. I'm going to
Excellent.
take a quick
Take
water
a reins
break
back
here.
with the question.
Yeah, sounds good.
We're getting some great questions today. So can we talk a minute about guarantees? So is the cash value and LTC benefits guaranteed with these products? Does it differ between whether you're going ABLTC or life with a rider?
That's such a great question. So yes, with the ABLTC products, that cash value growth is guaranteed. Now, I think it's always important to stress that the main purpose of this coverage is to fund those long-term care dollars as best as possible. But that is the big appeal to asset-based long-term care, is that cash value accumulation is strong. Now, it's not going to be quite as great as what you'd see with, a traditional life insurance product. And with life insurance, the way that those products are illustrated, the guarantees, the guaranteed column will look a lot different than the non-guaranteed column. So the growth potential is not quite what you see with ABLTC, but just know that that's a huge winning factor when it comes into play, and that's an added benefit to ABLTC that really can't be overlooked. But no, that is a great question, and the cash value growth within these contracts are guaranteed.
Good stuff. Yeah. So, unlike a traditional long-term care policy, it sounds like with these asset-based long-term care policies, they're guaranteed to benefit from it one way or another. If they live, they get the LTC benefit. If they die, they get the death benefit, of course. And if they choose to walk away, there's at least a portion or all of the premium that's returned to them. So definitely not a use it or use it play. It's much better than that.
So well put, Josh. I couldn't have said it better myself. That's a perfect summary of the big advantage with ABLTC for sure. Yeah, absolutely. Well, excellent. Shifting gears a bit, when we look at this next slide, when we talk about client profiles. So when we think about this, there can be a lot of competing priorities, right, with how clients go about funding this kind of coverage. Now, that can create a challenge when there's several different sources that are pulling their finances many different directions. So when we think about this, likely someone's still paying their mortgage, likely helping save for college funding for their children. And this is all while contributing to their own retirement programs like a 401k or an IRA. And then when we think about clients that are in that pre-retirement stage, they'll likely be in what's commonly referred to as kind of a sandwich generation, where they're still saving for their own retirement. They're likely still funding college for their older children. And some of you may have even experienced this, where there's a strong chance that they could be helping their parents with their aging needs and their long-term care needs as well. So with that said, in life pay designs, in some cases, your clients may be faced with the situation where maybe they can no longer pay for the premium on the policy, or maybe they want to have some flexibility where they can stop paying the premiums. So in a life insurance scenario, it's likely that those premiums, if that's an option that the client wants to elect, they can stop paying the premiums, potentially look at a non-forfeiture option, say, for example, a reduced paid up policy or an extended term insurance solution. And that can certainly provide a lot of flexibility and optionality, but it's also important to understand that there's going to be some trade-offs there, right? Where, let's face it, the benefits could be impacted. That total pool of LTC funds could be reduced depending on the way that life insurance policy is designed. So it's important to note that with ABLTC, there's going to be fewer options when compared to life insurance with long-term care riders. Now, typically, ABLTC does not allow for premiums to temporarily stop being paid. Certain carriers can offer a reduced paid-up option. There could be some type of cost recovery component, I should say. But in most cases, it might make the most sense to surrender the policy, recover that cash value. So again, in a worst case scenario, keep in mind that the cash value is a major benefit if the policy would need to be surrendered. Also, keep in mind that in that ABLTC space, exciting news here that it continues to grow with new products that are not only offering guarantees of keeping premiums level and fixed without increases, but they're new products that are built on IUL and VUL chassis that can not only offer that guaranteed component of the premiums and the LTC benefits, but there's the potential for even stronger LTC benefit pools, and that can be based on index or sub-account performance, and also the potential for the death benefit growth. And that's very unique to the ABLTC marketplace. Now, it's really important to keep in mind that many of these products, going back to 1035 exchanges, they perform really well with a 1035 exchange. So again, remember, this is a great opportunity to take advantage of this and really leverage that long-term care dollar even further. So again, when we bottom line this, when we like to emphasize this, there's never a one-size-fits-all approach to your extended care planning. So each client and their circumstances is certainly going to be unique. Now, you have the ability to offer that unique solution that suits your client's needs best. A lot of great content that we've shared with you so far here, but I wanted to pause again. Any questions?
We're good on questions at the moment.
So far, so good.
Yeah. So again, great information. I know a lot of great options. So one thing that we run into pretty often is there are those life insurance products that have inherent or sometimes referred to as free long-term care chronic illness riders, or at least free is the perception. Is it free? Can you tell us a little bit about those types of benefits in these types of policies?
Yeah, absolutely, Josh. And again, such a perfect segue into this next slide. So yeah, we'll dive into this deeper. Now, when we think about life insurance with a long-term care rider or a chronic illness rider, there's, when we think about all these different options, sometimes it can muddy the waters a bit and create some confusion. So which type of rider should I select? What type of charges would be associated with the rider? Is there an upfront charge? Is that included in the cost of the premium? Or is that charge calculated on the back end? How much can my client anticipate if and when they go on claim? So if the carrier is positioning the rider as quote unquote free, is it really free? Is the bottom line there. So many carriers will offer chronic illness riders where the death benefit can be accelerated for a qualifying event that's similar to to a long-term care rider, traditional long-term care, or an ABLTC rider. Now, the premium has an explicit charge, and that just means that the rider is elected at policy issue, and there's a maximum monthly benefit established at that time. And the good thing about that is that can establish a predictable amount of coverage month over month. But these riders can certainly be costly. And then when we take a look at the total death benefit coverage, in some cases, it might be cost prohibitive to have that rider included. Now, there's other options, right? They may not have an explicit premium charge, with that being said, an inherent rider is certainly not free. So chronic illness riders with the lien method, for example, that will act as the name implies, right? Where if the insured has a qualifying event, they go on claim, what will happen is the insurance carrier will pay the benefits to the insured via lien against the death benefit. So again, remember, these riders are certainly not free, and that cost can be significant. Excuse me. The other rider that would be inherent to the policy, that's referred to a mortality discount method. Now, in this scenario, when the insured goes on claim for that qualifying event, the carrier will apply a mortality discount. Now that'll be calculated at the time of claim. The net payment to the insured, that's reduced by administrative charges and mortality charges. And that'll be based on several different factors, like the client's attained age, but when they go on claim, their expected mortality, when that claim is filed, and so on. So at the surface, these riders might appear to be low cost or even free, but both of these riders can be quite expensive. As I mentioned before, they can be difficult to predict, right? Because you're not exactly sure exactly what you'd be receiving at that time you go on claim. And frankly, they could be counterintuitive to the main purpose of the coverage, and that's to leverage that death benefit first and foremost. Now, in addition to that, it begs the question, right? Are we robbing Peter to pay Paul? How impactful to the death benefit would those charges truly be? In most cases, as I mentioned before, your clients won't really know what impact that would be until they start tapping into the benefit. And depending on that situation, it could have potentially adverse effects to their care planning and their legacy planning. Now, here's the thing. In contrast with an ABLTC option, it's really important to remember that guarantees are the big distinction. Remember, the premium's guaranteed. That's fixed and level. It won't increase. The long-term care pool, that's guaranteed to be there so that your clients know what to expect when they go on claim. And they have the ability to grow that pool of funds with inflation riders that are available to them. And when the death benefit is guaranteed as well, that built-in component of cost recovery makes this such an appealing option on many different levels. So just remember, if death benefit is the goal, life insurance is typically going to be your best bet. When long-term care coverage is the goal, you're hard-pressed to find a better value than what ABLTC can offer. And also consider this, when we consider both ABLTC and life insurance with riders, if both are absolutely mission critical, then the plan should be covering both of those needs. Many clients will use a life with long-term care or chronic illness rider, and that'd be used in conjunction with ABLTC. And so you, as your client's trusted advisor, you can give them that peace of mind that all their needs are going to be covered when they need it most. Again, wanted to pause there for just a moment. So far, so good. Any other questions?
Boy, do we have questions right now. It's fabulous. Can we talk a minute about the chronic illness, right? The chronic illness is the same benefit as LTC with 2 of the 6 ADL trigger?
Yep, that's right. And so with the way that the tax code has been written over the years, one of the big advantages with many products with life insurance product with that chronic illness rider, it's essentially treated very similarly, if not almost identical to what you see with a traditional long-term care rider. So you're right. If there's the 2 of the 6 ADLs that cannot be met, or if there's that significant enough of cognitive impairment, that will trigger those benefits where the client can tap into those funds. So yes, that's a great question. Very observant. And so,
I'm sorry, go ahead.
No, you go right ahead, Maureen. Thanks.
So Mike, can we talk a minute? Is this a reimbursement plan? So if you're home and a family member is taking care of your needs, would that be covered?
Another fantastic question. So I always like to emphasize this. There are some carriers that offer cash indemnity in the way that they pay their benefits. There are others that pay via a reimbursement model. Now, that's a big distinction, right? And it's something that's important and should never be overlooked. So with indemnity carriers, right, if there's that qualifying event, let's say, for example, someone has the ability to tap into $5,000 worth of long-term care monthly benefit with an indemnity policy when they qualify. Typically, there's a 90-day elimination period in most cases. Then the client is free to access that full amount of $5,000 each month. And another thing to consider is, you may not necessarily need that full $5,000. Maybe you only need $4,000 or $4,500. You could take that additional $500 to $1,000 per month. You could bank it. You could use that to maybe do some home improvement expenses, put in a ramp, or maybe hire a dog walker service. You've got a lot of flexibility there. It's not to say that reimbursement is a bad thing. Reimbursement is a really solid option as well. Now, with reimbursement, your clients can tap into that benefit as well. It will pay above and beyond the HIPAA per diem limit if that's needed. So just know, not to dive too deep into the weeds here, but there are carrier options where carriers will either offer a reimbursement model or an indemnity model. That can be a driving decision maker. And that way you can help position one product over the other and help your clients determine which is going to be the best solution across the board.
Thank you. When you have a second, we definitely want to talk about underwriting considerations for all of these options. Is there a best choice for clients that have some health issues? And how does that all factor in?
Yeah. So when we think about, when we're kind of comparing and contrasting the two ABLTC versus life insurance carriers, there are some carriers that may have a little bit higher appetite of risk than others. And I'm sure a lot of us have experienced that on the life insurance side. The same is for the most part true with ABLTC carriers. That's one of the big advantages of how you can lean on the team at DMI. So if there is any kind of underwriting concern, we always want to do as much field underwriting as possible ahead of the game. So then that way we can isolate which carriers are going to look best, whether it's life or it's ABLTC. So that, I think that's a really astute observation. Yes, underwriting is going to play a factor. Some carriers will be a little bit more lenient depending on certain sectors, certain conditions. So let's utilize our specialists. Let's do as much field underwriting as possible and pinpoint the best product option and carrier option ahead of the game.
That's great. Absolutely. I always encourage everyone to lean on your specialist at DMI for that.
For sure.
And that is it for questions for right now.
Okay. Excellent. Very good. So, when I think about this, it's the why. Why these conversations are so important. Josh mentioned this right there at the onset, those unexpected LTC expenses that can just absolutely devastate your finances. We think about the government programs that we have available, like Medicare and Medicaid. It's going to provide limited coverage at best, and in all likelihood, it's going to fall short of your client's needs. And then also waiting to buy LTC protection. That could lead to potential denials of coverage. That could be with deteriorating health conditions or pre-existing conditions that might preclude them from coverage. And we know that having that extended care conversation with your clients can sometimes be difficult. But it's so important to have this conversation. It should never be overlooked. Important to remember that all your clients deserve to have this extended care planning conversation with you. Let's face it, the sooner this conversation is had, it's certainly for the better. For extended care needs, I think it's really important to ask your clients, if you needed care, what is your plan for care? And with that being said, what kind of care would you want? Who would provide the care? How would you receive that care? And more importantly, how would you pay for it? Excuse me. So this really helps move that conversation to a solution that you can present to your client, provide that value where it's needed most. It really helps illustrate to your clients that you really truly have their best interest in mind. And I go back to statistics, and I think this is important to highlight. Studies show that your clients, now more than ever, they're looking for that peace of mind, right, with their planning. And so most consumers, 52% of respondents, they believe that having a plan alleviates their worry, but only 33% of those respondents say that they feel confident that they have a plan in place that would meet their goals. 46% believe that LTC event that would devastate their finances and retirement planning, that equal amount, that 46% want to remove that burden from their family members if they were in a situation where they needed that care. So these studies show that there are differences in attitudes by age as well when planning for care. Now, most consumers over the age of 60, they say that they've had experiences with close family members or maybe a friend who needed long-term care. That drove them to create a plan for themselves. And with that being said, younger consumers, studies are showing, folks that are right there in their 40s or so, they have those same or similar experiences with, and they're more significantly more likely to take action. 96% of those respondents said that they'd be willing to take action on the clients that are on the younger end of the scale. In addition to that, younger consumers, they place a higher priority on meeting their family's protection needs with hybrid solutions that can combine the life insurance along with the LTC protection. So here's the thing, is consumers, they want that voice in their care, where they'll receive it, who will be providing it, the quality that they can expect. Here's the thing, is the best way to do that and still protect their retirement nest eggs and that legacy that they want to leave is to identify how they might pay for LTC in the future. Here's the thing, the time to create that LTC plan, it's just absolutely critical, right? That time to create that LTC plan, it's so absolutely vital. So let's make sure your clients don't wait till death's door to put that plan in place. The time for planning is now. So really, in conclusion, your clients, they're open to these ABLTC options and more importantly, your professional guidance. So this highlights that importance of you as their trusted partner to give them the guidance they need. And so, if you can think of any clients that would like to start that care planning conversation with, or you'd like to discuss sales strategies, please reach out to Josh and the team at DMI to ensure that your clients have that protection that they need.
Thanks, Mike. I think Maureen's got a good question that I'm seeing here too on a
Always
candidate.
Got these great questions, Josh.
Yeah, good questions today. Go ahead.
So I'm just going to ask this out. Just going to read it as it comes. Is there a sweet spot or an entry level where you think a client is a good candidate for ABLTC? Is it greater than 500,000? Is it less than 500,000?
Oh, no, I wouldn't say that. No, I wouldn't say that from the perspective of, a certain amount. I view it from the perspective of let's base it on the need, right? So what can we, potentially anticipate by way of a monthly long-term care benefit? So I wouldn't necessarily that there's going to say that there's going to be a sweet spot per se with, a funding strategy. I view it from the perspective of what need are we looking to protect the most? So with that being said, though, depending on the way that the pay design works, if it's going to be a shorter pay, depending on age restrictions or what have you, certain carriers are going to shake out to look better than others. But that's what we're here for, right? So we can take those different variables, run with that and position the best product available. So no, I wouldn't say that it's going to be a sweet spot in that regard. I'm looking at it more from the perspective of what's the amount of care that they need, the type of quality care that they're looking for. And that's really going to be the driver in the decision-making process that we always like to emphasize.
Yeah, I think that question kind of lends itself to if the client doesn't have much, and maybe ours, the advisor's opinion, if they don't have many assets and they don't need it. But as you said, it's about how do they envision the care? Do they want to go to a Medicaid qualified facility if that's what we think we'll qualify for? It gives them the flexibility to choose. So,
for sure. And it's not to say that traditional long-term care is always a bad thing. Having some kind of care option is always going to be a good thing. So if maybe a cost barrier is a consideration, then a traditional long-term care policy could make a lot of sense. But we've seen so many pricing improvements with ABLTC where it's so competitive, especially in those longer pay designs, and it just makes that ABLTC option even that much more compelling.
Is there a way to use qualified monies to pay for long-term care?
There certainly is. So it's a little bit more limited, right? There's one carrier that will offer qualified funds. The way that it can be utilized, and I think again, this is leading into the subsequent webinar that we have coming up, funding sources, qualified versus non-qualified funds. But yes, qualified funds can be used to fund ABLTC. We have one carrier in particular that will use that fund in a single premium design. They'll stage that premium over the course of 10 years and spread out that taxable gain and make it a very favorable solution. There's ways that you can work around that, so to speak. You could look at maybe utilizing an outside used SPIA to fund a different type of product solution. But yes, I mean, now more than ever, there's fantastic options when we consider using qualified funds. And that's where, again, the team at the DMI can help you isolate and pinpoint those best solutions.
Yeah, Maureen, Ann, and our partners have helped us solve for a couple of really big cases, actually, where we carved out a portion of the qualified funds, used an annuity to fund the asset-based long-term care product. So it's great for the client, and it's really good for the advisor's business as well.
Great. And I'm actually going to be, when I send the follow-up emails to everybody that's on this webinar, there'll be a link to sign up for the next webinar if anyone's interested in finding more about how to use qualified money to pay for LTC. But Josh, with you talking about, business owners, what about LTC and asset-based LTC, using those with the business owner market?
Such a great question. Yeah, and here's a big benefit in using asset-based long-term care. Now, if a business purchases an ABLTC insurance policy for an employee, now the business wouldn't own the policy; they're just paying for it. The business can deduct 100% of those premiums, and so in addition to that, the life insurance premiums can be deducted by the business as compensation that's paid to the employee. So that'd be considered income to the employee, which they'd have to pay tax on. That LTC premium, that's 100% tax deductible to the business owner and is not considered income to the employee. So this is a great way to recruit, retain, and reward key employees. So just know that this strategy can be beneficial to business owners and key employees alike.
That's great information.
Awesome.
Absolutely.
And I don't think I have any more questions right now, gentlemen.
Excellent.
Okay.
Well, again, I sincerely appreciate the opportunity to be here with you all today. I just look at it from a personal perspective. I'm a family member of mine utilized a long-term care policy. And I look at this situation where if we didn't have that resource available to us, I shudder to think about what would have happened. So I know how important it is to lock down that peace of mind, have that protection in place. This is such a great opportunity for you to connect with your clients. And I sound a lot like a broken record here, but it's vitally important. Let's get them the protection and the coverage they need. And the team at DMI is perfectly positioned to help you take it to the next level. With that being said, I wanted to make sure that we highlight this last slide here. So for any additional resources, you can reach out to Josh and the team at DMI with the QR code that's available to you here. And everyone, thanks again. I really appreciate the opportunity.
Thanks, Mike. Great job. Thank you for presenting all that. And really, the magic in these webinars is in the follow-up. So especially if you haven't been doing much of this, Mike did a great job, but if you're not familiar with it, it might have been like drinking from a fire hose. And if you have clients that you really haven't discussed this with, no shame. Let's just start now. Pick one, reach out to me. I have a sales kit that I can send to you when you reach out to me that can help you have these conversations, to help guide your conversations, can help calculate the need. I have all those tools in a simple kit that I can send to you. So just follow up with me, and we'll make the best use of this time today by taking a look at a specific client in your book of business to see which of these products would work best and how. And not for nothing, get you a good amount of compensation for these. This can make a good year into a great year with just one or two of these asset-based long-term care cases. So we'll talk about that one-on-one as well in terms of how this can benefit your business from a compensation standpoint.
Thank you so much, Josh. You guys were both like professors today, Professor Mike, Professor Josh. Thank you so much. No, really, we appreciate you guys taking the time to break this down for everybody and bringing clarity around the topic. So, and I'm sure that's what we're going to do on October 23rd as well, when we talk about unlocking sales opportunities for tax-free LTC, right? We do also have a special business owner market roundtable coming up in December. So that question regarding, does this apply to the business owner market? Yes, it does. That could definitely, if you get in on that, that could be a part of the conversation there too. So I think that's it for today. Really enjoyed it. Thanks for all the questions from the audience today. It really, really helps us better understand what your needs are. And feel free to reach out to Josh anytime. He's happy to help. So, and Maureen, Andrew, thank you very much for your support on this. It's fantastic. So everybody have a great rest of your Wednesday, and we'll see you in 2 Wednesdays from now, October 23rd.
Thanks, everyone.
Thanks again.